Hi, and welcome to the Stock Scores Market Minutes for April 30th, 2018. This week's topic, what to do when you are wrong. Any experienced trader will tell you that being wrong is inevitable in trading. It's really how you react to being wrong that has a big impact on your performance. You need to know the price levels that prove you wrong. If you buy a stock and it falls down through support, you've been proven wrong. If you are sticking with a trade that is in an upward trend and it breaks that upward trend, then the trend is over and being bullish is wrong. It's important to get out of the trade when the market tells you that you are wrong, but also to consider whether the market is showing you a new opportunity. For example, the other day I was buying stocks on the open as day trades and the market broke down through support. It wasn't what was expected given the pattern that had been building in the market, and that in itself told me that the buyers were not as strong as they appeared to be when I was buying, and so really the opportunity there was to start going short the market, and we ended up getting a pretty sharp sell-off. So taking valid trades from the new opportunity once you've been proven wrong is sometimes a way to really take advantage of what you've been told by the market. All right, let's get into this week's analysis. Here's the S&P 500. It is the 30-day, 60-minute chart, of course. And we'll just recap there. We had the upward trend line. We broke that. We had a little downward trend line. We ran away from it. That means we were oversold. Came back to it Friday, Thursday. Built a little rising bottom, looking for the breakout. The market's been quite choppy lately. We're not getting as lengthy of trends as we have in the past. Notice that this trend here is longer than this trend, and now this trend is shorter, and now this trend is even shorter. So we're getting this condensing of volatility, and that makes trading more difficult because the trends aren't lasting as long. Neither side, bullish or bearish investors, neither side is really committed, and that typically comes before a directional break. You're getting this condensing of volatility. It's like a coiled spring, but it's frustrating to trade that market until you get a break out of that compressing volatility. Moving along to the longer term chart, we still have a valid upward trend line. You can see with the weekly chart here, look at how narrow the bodies are each week. Can everyone see that? You know, if I look at the bodies of the candles over the last 5 weeks, they're very, very narrow in terms of being close to the open and then closed together. Compare that with the weeks prior where you had a lot of volatility through the week, and that shows that again there's that lack of commitment by one side or the other. There's not a lot of buyers buying or sellers selling. It's kind of going back and forth day by day. Onto the Russell 2000, which continues to underperform the large cap stocks, but it is building a pennant pattern, and if we can break out of that pennant pattern, then we should get a directional move. For now, there's nothing really there, but something to watch for. Can we break through this resistance line, or will we break down through support? Watch for that in the weeks ahead. Onto the Canadian market, which is really the better performing market in North America. And you can see that we've got a decent little upward sloping channel in place right now. That is being driven largely by the strength in the energy sector, which then filters down to some of the other sectors in Canada which benefit from strength in oil. I don't think that this is a considerably bullish market by any means. We're really a neutral market if you look at the last 30 days, and we are coming into this horizontal resistance where the market will get stuck. But there are some opportunities in the Canadian market if you are picky. And looking at that long-term chart, we're really still stuck in that sideways range that we've talked about for some time, and in the last 3 months pretty much just sideways, so we have to call it a neutral market. Onto the TSX Venture. We have our downward trend line in place. We ran away from the trend line. We all know that when we run away from the trend line, we come back up to it. We got stuck and we've moved lower. If we can build a rising bottom, if we can then break the downward trend line, then it's time to be optimistic about the TSX Venture stocks. Until that happens, I would be quite cautious. Onto the Treasury bond market, which is an important chart to look at because it tells us a lot about interest rates. You can see that the general bias in this chart is down. We have falling tops. We are testing some long-term support. We bounced off of that support last week If we can hold that support, great, but given the pessimism building on this chart, there's a decent chance that in the months ahead we will break down through support, and that means rising interest rates. US dollar, interesting chart because it has broken this downward trend line, and that has not happened in a very long time. We have been in a downward trend since late 2016, and we finally broke it after building some rising bottoms, and that points to a higher US dollar ahead. And that's somewhat bearish for the commodities, which of course will suffer if the US dollar rises. So we have this conflicting message because we've got oil making advances, and now we've got the US dollar making an advance as well. Which one's going to win? Only time will tell. But one thing is for certain is that strength in the US dollar has hurt gold. As we can see that gold prices dropped last week, we are still under that resistance level. So it's a neutral market because the upward trend line is still intact, but we need to break through resistance before we get very optimistic. And here's the oil chart. You can see we remain in that upward trend, upward sloping channel. No reason to think it should stop until the trend line is broken, but I'm a little concerned about that strength in the US dollar. It could cause this market to slow. And finally, the fear chart. We had a little eruption of fear this past week, but it's dissipated again into the end of the week. However, it's still elevated compared to where we were. So that means investors are still edgy, still nervous, and we tend to see when there's weakness, the weakness to get quite strong because a lot of people are jumping ship out of the market. So I think we still have to be cautious about this market and watch for the next directional break out of low volatility. So I'm neutral on just about everything except for oil. In that case, I am bullish on both time frames. US stocks endured some volatility to the downside this week, but regained most of that lost ground into the end of the week. Still, they are unable to make a convincing break through support or resistance. They're stuck in a range with lots of whipsaw action. Canadian market is benefiting from strength in oil, which continues to work higher. Gold remains stuck as the US dollar moves up. And now on to the trade of the week. This was a worm trade on Friday, I believe. Can't remember what, yeah, this was Friday's trade. And you can see there the bearish action candle. It has all the things I like to see. First of all, the stock was weak. It was building pessimism. It was compressing in volatility. You can see less and less volatility. And finally, the stock scores bearish action candle right there, and that telegraphed that downward move into the close for a pretty good reward for risk trade of about 6. Well, hope that you've enjoyed the video. If so, click on that like button, subscribe to the channel, click on the little alarm, and you'll get instant alerts when I upload a new video. And most importantly, trade well.